Hey guys, this is Vyom Joshi with Superior North, and today we will be reviewing the Form 10K for Tesla. Uh, I know Tesla has been in the news a lot recently, simply because it appears that the stock only knows to go in one direction, and that is upwards. So every day that I look, it just looks like the stock just wants to keep going higher and higher. So it's important that we review the 10K, which is the annual report, to better understand what Tesla thinks the business is about, and not only what the mainstream media or your friends say the business is about. So we'll look at the business model, the risk factors, and then we'll go on to Morningstar to see what the trends have been as far as the fundamentals go. And then at the end, we'll also jump in to see if we can somehow figure out how the intrinsic value of Tesla can be derived. So starting off, the business model, I'll sum it up here, what the 10K tells me or tells you. It's pretty much this one sentence right here where Tesla tells you that they report in two segments. They're automotive, and the second one is the energy generation and storage. And throughout this business, if you read through, they talk about each and every like for example, right, for their automotive segment, they talk about the models they have, and then they'll talk about the technology that they use, then they'll talk about the design and engineering, and the same thing for their energy generation and storage, right? Like all these, they talk about both the segments, the developments that they have had in the past year. But what I'm trying to say, the important takeaway here as far as the business is concerned, is they're not only a car company, they're also an energy storage and a renewable energy generation company, especially with solar cells, the solar panels, and the power walls that they have with their energy storage. So the whole goal, right, the overarching idea that people have of why Tesla is going to be the future is because they have this model where you have the cars, yes, but then there is also the energy storage and generation where people are going to have solar roofs. They're going to generate their own power. They're going to store that power, and then they might even put it on the grid and sell it back to the utility. So they're in two segments, and it's important for people to not only look at the car business, but also the renewable energy and storage business. Let's quickly look at the risk factors now. Tesla, by the way, has a lot of risk factors, so we might be here for a minute. It's nothing new for a growing company. There is going to be a lot of risk involved with investing in Tesla. So risk factors, risk related to our business and industry. They say that we have experienced in the past and may experience in the future delays or other complications in the design, manufacturing, launch, and production ramp up of our vehicles, energy products, and product features, or may not realize our manufacturing cost targets, which could harm our brands, business prospects, financial conditions, and operating results. So that was a mouthful, but all they're saying is, hey, there might be delays, and we might not be meeting those targets. And I think if you know Tesla, if you know Elon Musk, that is nothing new. They're going to have delays, but the thing to note about Tesla is that they deliver, and or Elon Musk likes to deliver. So they're going to have delays. It's a fact, and they know about it, and they laid out in their risk factors as well. The second risk factor is we may be unable to meet our growing product sales, delivery, and installation plans, and vehicle servicing and charging network needs, or accurately project and manage this growth internationally, any of which could harm our business and prospects. This is nothing new for a company that's trying to disrupt the market. They're not going to be the same number of charging stations as gas stations. It's not going to be easy to deliver, especially during the pandemic, right? I mean, this report came out at the end of 2019, so it wasn't in the foresight, but this is clearly a tough scenario, and this might be a risk that is being materialized right now. especially with the growth and delivery and installation plans. The next one that they have is we're dependent on our suppliers, and majority are single source. So again, anything that is in the supply chain could disrupt Tesla's bottom line, especially if they have some predetermined schedule and price at a certain level. If their suppliers are not able to meet those obligations, then Tesla is going to be affected. Any problems or delays in expanding the Gigafactory, again, this is more on the production side of things. Any issues or delays in meeting our projected timelines at the Shanghai Gigafactory. Again, this is more specific as far as the expansion goes. We face risk associated with our international operations, including unfavorable and uncertain regulatory, political, economic, tax, and labor conditions. Wow, that's a lot. With establishing ourselves in new markets, all of which could harm our business. So again, that's quite a bit of things, quite a bit of risk. It's like they want to ride it all. Increases in costs, disruption of supply, or shortage of materials, in particular lithium-ion cells, could harm our business. Again, lithium-ion cells are used for their batteries, so it is definitely a risk, especially if there's a shortage. It could increase the price for them and hurt the Tesla's bottom line. If our vehicles or other products that we sell or install fail to perform as expected, our ability to develop, market, and sell our products and services could be harmed. I think this is probably a risk factor for all automakers, simply because if there is a problem with the product, with the model, they are going to have recalls, and that is going to be costly. So the other risk factor is we may become subject to product liability claims, which could harm our financial conditions and liquidity if we are not able to successfully defend or insure against such claims. Again, for a growing company, the more cars they sell, the more susceptible they are to being sued, or as far as the liability claims go for their products. The markets in which we operate are highly competitive, and we may not be successful in competing in these industries. Again, Tesla is a disruptor, and it's going to face a lot of competition. That goes without saying. If we are unable to establish and maintain confidence in our long-term business prospects amongst customers, analysts, and within our industries, or are subject to negative publicity, again, this is all goes to show that the brand Tesla is important. Like, for example, let's say you start hearing things about how the Tesla cars start crashing, or the batteries start, catching fire, then that is undoubtedly going to affect Tesla's sales, because people are going to trust Tesla less. It just negatively affects Tesla. So again, a risk factor. If we fail to effectively grow and manage the residual financing and credit risk related to our vehicle financing programs, our business may suffer. Again, this is Tesla saying that, or pointing out that they do not have a middleman, they don't have a dealer. They go straight to the customer, and if the customer wants to finance, then they're going to have to finance the car for them. And leasing goes the same way. The unavailability, reduction, or elimination of or unfavorable determinations with respect to government and economic incentives in the U.S. and abroad, supporting the development and adoption of electric vehicles, energy storage products, or solar energy could have some impact on the demand of our products and services. Tesla here points out that they gave example of under current regulations, a $7,500 federal tax credit that was available in U.S. for purchase of our vehicles was reduced in phases during 2019 and ended in December 31st, 2019. So that's again an example where people now have a lesser of an incentive to actually purchase an EV if their incentive was to get the $7,500 tax credit to begin with. So just Tesla pointing out that their favorable conditions, the government support, might be needed for them to increase their sales in certain places. The next risk factor is if any failure by us to comply with the terms of our agreement with the Research Foundation of the State University of New York relating to our Gigafactory New York could result in negative consequences for our business. I think this point also shows up in note 16, which is later down, as a contingent liability where, as they point out, that they would have to spend $5 billion and within the 10-year allocated period. And it's just that if they don't do it, then they have a fine of about $41 million. So again, it's a risk of doing business with, you're getting some better terms to do business there, and in return you have to spend money in that state. So nothing new there, but again, it's a risk factor that Tesla would have to spend $5 billion in the state of New York during the 10-year period beginning in April 30, 2018. Next one is if you're unable to attract and or retain key employees and hire qualified personnel, our ability to compete could be hurt. They specifically point out Elon Musk. They say that, or Tesla says that they're highly dependent on the services of Elon Musk, their chief executive officer. Next up, they talk about we're highly dependent on the services of Elon Musk, our chief executive officer. So I guess the previous point ties in down here, where they talk about why they're so highly dependent on Elon, especially given that he's the largest shareholder. Next, we are continually expanding and improving our information technology systems and use the security measures designed to protect our systems against breaches and cyber attacks. This you're going to find in every 21st century company's 10K, is that they're susceptible to IT cyber attacks where your information could be breached and whatnot. And I think it's more important for a business like Tesla, which is so dominant in not only driving, where someone could take over the car, but also on the home management side with the energy storage and energy generation that they're doing, that people can mess around with the way your home operates, right? So it is important for Tesla to display that this is one of the risks where the business could be harmed. Any unauthorized control or manipulation of our products, systems could result in loss or confidence in us and our products and harm our business. So again, I just pointed it out in the previous example where you start manipulating an unauthorized person, a hacker starts manipulating the way cars operate, the way your home's operating, the way your generation's done. It's definitely going to harm Tesla's reputation and also the brand name. So we are subject to substantial laws and regulations that could impose substantial costs, legal prohibitions, or unfavorable changes upon our operations or products. And any failure to comply with these laws and regulations, including as they evolve, could negatively impact our ability to operate our manufacturing facilities and substantially harm our business and operating results. So it's just saying that they have to comply by law. If the laws change, which they do quite often, then that could negatively affect their margin. And they give out examples. Failure to comply with a variety of U.S. and international privacy and consumer protection laws to which we are subject could harm the company. I think in general with companies, the more they have to comply, they know that the less money they're going to make as far as profit is concerned. So that, from a financial perspective, is certainly going to harm Tesla, because they're going to have additional fines, penalties, and damages. Next is our business may be adversely affected by any disruptions caused by union activities. Next, we may choose to or be compelled to undertake product recalls or take other similar actions which could adversely affect our brand image and financial performance. So I think this, as an auto manufacturer, it is important that you make the least amount of recalls, and I think at a certain point recalls are inevitable, and the best they can do is make sure that going forward they don't have recalls, or they have the least number, because the more recalls you have, the more costly the servicing of that model or that product is going to be, and it certainly eats into your profit margin for the company. So something that is definitely not only a risk factor for Tesla but all automakers. Our current and future warranties reserves may be insufficient to cover future warranty claims, which could adversely affect our financial performance. Again, this is a big risk because in case people start having additional claims, if something is wrong with the product, then and people want their money back, then that could definitely put Tesla in a bind as far as their liquidity and finances go. Our insurance coverage strategy may not be adequate to protect us from all business risks. Our financial results may vary significantly from period to period due to fluctuations in our operating costs and other factors. Next, servicing our indebtedness requires a significant amount of cash, and there is no guarantee that we will have sufficient cash flow from our business to pay our substantial indebtedness. That's Tesla saying that, hey, they're debt-ridden, and there's a possibility that they might have a significantly hard time to pay off their debt, their current obligations, if they don't have the cash generating mechanism. Our debt agreements contain covenant restrictions that may limit our ability to operate our business. We may need or want to raise additional funds, and these funds may not be available to us when we need them. If we cannot raise additional funds when we need to or want them, our operations and prospects could be negatively affected. So I think with Tesla, I've seen Tesla's shares outstanding, especially not only from financing on the bond side of things and asking issuing senior securities, but also as far as equity financing goes. If you look at a 10-year period, Tesla's shares outstanding has been growing steadily, which just goes to show that there is a lot of equity financing that's done by Tesla in order to generate money. We could be subject to liabilities, penalties, and other restrictive sanctions and adverse consequences arising out of certain governmental investigations and proceedings. Again, to do with the government. If we update or discontinue the use of our manufacturing equipment more quickly than expected, we may have to shorten the useful lives of any equipment to be retired as a result of such update, and the resulting acceleration in our depreciation could negatively affect our financial results. I think this is more on the accounting side of things, that if they do aggressively depreciate, their income statements might look very different, even though their cash flow might still be the same. But as far as income statements go, the bigger the depreciation, the smaller the bottom line number that you'll see. Next, we're exposed to fluctuations in currency exchange rates, which could negatively affect our financial results. I think as an international company, everyone has that. We may face regulatory limitations on our ability to sell vehicles directly, which could materially and adversely affect our ability to sell our electric vehicles. This is again Tesla trying to get rid of the middleman or the dealer, and how they might run into or face regulatory limitations as far as if they can do that or not. Next, we may need to defend ourselves against intellectual property infringement claims, which may be time-consuming and could cause us to incur substantial costs. Again, it goes without saying, if someone sues you for intellectual property, you're going to defend yourself, that's going to be costly. And if it were to go south, then you would also have to pay. So again, a bag of worms. Next, our facilities or operations could be adversely affected by events outside of our control, such as natural disasters, wars, or health epidemics. So that's the risk factors. Now, risks associated or related to the ownership of our common stock. So that's the shareholders, you and I, the risk that we specifically face, not necessarily. So what we had talked about so far was the risk for the company, right? That if as an operating company, these are the risks that we face. But now what we're talking about is if we were the shareholders, if you were to buy the stock of Tesla as a shareholder, what are the risks that we face? They point out that the trading price of our common stock is likely to continue to be volatile. They talk about how it was close to $1,000 and it was about $200 within a 1 year period. So certainly very volatile. Next, we may fail to meet our publicly announced guidance or other expectations about our business, which could cause our stock price to decline. Again, Tesla is known to delay the delivery and delay the timeline. Tesla delivers, right? Don't get me wrong. Elon Musk is known to deliver, but it just might not be when he says that Tesla is going to deliver. So again, a risk because if they don't deliver when they say they'll deliver, it fluctuates the stock price. Next, transactions relating to our convertible notes may dilute the ownership interest of existing stockholders, or may otherwise depress the price of our common stock. So again, this is more for common stockholders who intend to stay with Tesla for a long period of time. And you're not just in it for the quick money. If you're going to stay with Tesla for a longer period of time, then your ownership in Tesla is going to dilute, because this convertible notes, once they get vested, once they reach a certain level or a certain age, it can be converted into shares, and those are new shares that are going to be issued, and that's going to dilute your ownership of Tesla. Next, Elon Musk has pledged shares of our common stock to secure certain bank borrowings. Next, anti-takeover provisions contained in our governing documents, applicable laws, and our convertible notes could impair a takeover attempt. So those were all the risk factors associated with Tesla. It was quite a lot. Hopefully you guys are still with me. The other one that I really wanted you guys to look at is Note 16, which is the contingent liabilities. Now these are the liabilities that Tesla doesn't expect them to be liabilities, but they're just liabilities nonetheless, and they don't show up on the balance sheet simply because the lawyers or the accountants don't expect them to happen. It's the probability, right? That if it's not going to happen, if it's not likely to happen, there's no point of including it into the balance sheet or as a liability. It's just, it may happen, right? And at that point, they still would be covered under this notes that, hey, look, we talked about it. So we'll just quickly go over these contingent liabilities and their commitments. The operating lease agreement. We just talked about this as well in the risk factor, if you recall, where they talked about how they would have to spend a few $1 billion. I think it was $5 billion. $5 billion. We're required to incur $5 billion in combined all in the state of New York within a 10-year period. I think it was following April of 2018. So if they don't do that, then they would have to pay $41 million to SUNY, which is the State University of New York Foundation. Next, operating lease agreement in Shanghai, China. This is a term of 50 years. Similar provision, or similar as the previous one with the New York thing, where they would have to spend a certain amount and give a certain amount as tax revenues for the government. Next is legal proceedings. Now they just talk about all the cases that they are currently running or fighting against in court. The securities litigation relating to our SolarCity acquisition. Again, this is an old one. And I think this is nothing new, especially when a company gets acquired. A lot of times the shareholders feel that, or shareholders of the company being acquired feel that they did not get a good bargain, and they're going to court because they think that their interest wasn't heard, and the parent company is not being just to them. So next, securities litigation relating to production of Model 3 vehicles. I think over here, as you can see, the lawsuit claims that Tesla supposedly made materially false and misleading statements regarding the company's preparedness to produce Model 3 vehicles. So that's just them not delivering on time, and they got in a little bit of trouble for that. The next one is litigation relating to 2018 CEO Performance Awards. I think a lot of times the shareholders have an issue with the way Elon Musk's compensation is set, And if you look at the way his compensation is set, yes, you'll see that how he's not making any money, right? As far as he's making minimum wage from Tesla, but the way that his stock options are getting vested, and at certain levels, right? It's the way he gets compensated is by what the price of the stock is. So if it's at $200, he's going to be 10%. He's going to get 10% vested of his allocated amount. And so if every time the stock prices goes up, he's making more and more money, and more shares are being vested. And he's, as a shareholder, right? Like if you and I are shareholders of Tesla, Elon Musk, and the way he's being compensated is diluting our interest ownership of Tesla. So again, litigation for his performance, and it's just that the company in itself is not making profit. Well, they are from an accounting standpoint, in if you look at the trailing 12 months results, but as far as year-end results go, Tesla has never made a profit. So regardless, the fact that they haven't made a profit and Elon Musk is being paid so well as far as stock options go, is stock-based compensation goes, is very eye-opening. Next one is securities litigation relating to potential growing private transactions. So this is, I think, when Elon Musk tweeted that, hey, Tesla's going private, and there was no merit in it, and Tesla got in trouble, or Elon Musk got in trouble for that. Settlement with SEC related to potential going private transaction, that's specifically for Elon Musk. And I think they also had about some fines as well, civil penalties of $20 million each. So again, a risk because it hurts Tesla as a company. Certain investigations and other matters. So now they talk about a whole just bunch of things where the DOJ is getting involved, the SEC, and nothing new for Tesla. Next, indemnification and guaranteed returns. I think that is with their underlying solar energy systems, and with the U.S. Treasury and the IRS, and how the finances would be eligible and how all of that would work out. And lastly, the letter of credit. As of December 31st, 2019, we had 282 million of unused letters of credit outstanding. So that is all that Tesla has as far as our contingent liabilities go. So that was all that Tesla had as far as the business is concerned, the risk factors and the contingent liabilities. I think it's about time that we take a look at the finances and the fundamentals of the business. Let's go to Morningstar. So now we are on Morningstar for Tesla under key ratios. We have all these numbers, but let's quickly look at the financials real quick before we hop back to key ratios. So for the income statement under financials, we see that for the revenue, the number has been growing, which is great. You want to see a company that has growing revenue. Back in 2015, it was at 4,000. 2019, 24,000. Again, this is in millions of dollars, so it is growing. And we'll look at these numbers in the key ratios as well. The other important number that you want to look at is the net income. This is the bottom line of the company. As you can see, for a 1-year period, Tesla has never recorded a profit. Now, for the trailing 12 months, right? Yes, they have recorded a profit. But as far as for the year of 2019, for the year of 2018, the whole year-end period, they have never recorded a profit in their history. Next up, we want to look at the balance sheet. In a little bit, when we look at the key ratios, the numbers that we're going to be comparing are the total assets, which are made up of receivables, inventory, prepaid expenses, and other current assets, along with cash and most liquid assets. So if you add all these up, you're going to get current assets. Current assets are things that are cash-like or cash, or that can be converted to cash within a 12-month period. So that's your current assets. We're going to be talking about this in a little bit. And as far as current liabilities go, we're going to be talking about this as well. These are all the things, for example, your short-term debt, your capital leases, account payable, tax payable, accrued liabilities, deferred revenues, and other current liabilities. These are all the things that the company will have to pay to someone within a 12-month period. Hence, they are called current. So We'll be comparing the current assets, current liabilities in a little bit, and then quickly looking at free cash flow, or the cash flow statement. I want to show you guys how free cash flow is derived. The way Morningstar finds free cash flow is it subtracts capital expenditures from its operating cash flow. The operating cash flow is what the company makes from its core business, right? And that is, for the trailing 12 months, it was $27.05. Again, this is in millions of dollars. And you subtract it from all your investments, so the expenditures that you do from that cash. In this case, it was $19.35. So you subtract those two numbers and you're left with $799 as your free cash flow for Tesla. So now going back to key ratios, we have the top line, which is the revenue. We just looked at it, but now we can look at from 2010 till trailing 12 months, which is 2020 or August 2020. And if we look at the bottom line, it has always been negative, right, for a year-end period in 2019. Maybe in 2020 year-end it might be a different story, but you never know with the pandemic how many cars Tesla might end up selling. And with the incentive that expired in 2019, it might be a little bit harder for Tesla to pull it off. Next thing we can look at are the shares outstanding. These are in millions. In 2010 it was 51. In 2020, the trailing 12 months is 191 million. So as you can see, Tesla has clearly diluted your ownership of Tesla stock by quite a bit. And this is nothing new for a young company that's trying to finance its way through by equity financing. It's just that if you are thinking about buybacks and how buybacks work, this is the complete opposite, where the company is issuing more shares so that it can generate more cash for the company. Okay, so now we can see the financial health of the company. Over here we have current ratio. As you can see, for the latest quarter, it's 1.25. That's good. It's above 1. All that tells me is Tesla has enough current assets to meet its current liabilities. Over the years, Tesla's leverage has been decreasing if you look at from 2017 to now, but it's fluctuating all over the place. Their debt to equity ratio is a 1.17. Again, this is more than 1. It just shows that in comparison to the equity, they have more debt. Next, we can look at the efficiency ratios. As you can see, the days in the inventory, Tesla has been more efficient over the years. As you can see, in 2010 it was 145 days in the inventory, but now in 2019 it's reduced to less than half of what it was 10 years ago. So definitely more efficient now than before. The other number that we can look at is the inventory turnover number, where back in 2010 it was a 2.51 and now it's more than 6. So that's again how many times the inventory goes through, and the bigger the number, the better. That's what you want, and Tesla is going in the right direction as far as inventory turnover goes. Next up, we can quickly look at the profitability of Tesla. Return on equity has always been negative, except the trailing 12 months, but as of year end, it has always been negative. Same with the return on invested capital. This is the capital that Tesla is investing, that Elon Musk decides this is where we're investing and what's the return that the company is racking on those investments, has always been negative as well. So now I think we can try to see what the valuation of Tesla might be using this one number of 968, and assuming that the free cash flows would just grow in the future. And it will be a very liberal estimation, but it'll be interesting to see what it might turn out to be as far as what the DCF analysis goes, and also on the expected rate of return side, if we can predict what that number may be. So let's dive in. Hey guys, so before we dive into the DCF analysis and the expected rate of return calculations, I wanted to quickly bring your attention to the current valuations of Tesla as far as the price to earnings go. As you can see, the PE number for Tesla is at about 800 as compared to S&P 500, which is 25. The price to book at 31 as compared to S&P of 3.5. Same with price to sales, way higher than the S&P 500. Price to cash flow. This is showing me that the market is discounting the fact that Tesla has this bright future and they want to be a part of it, and people are willing to pay a premium to be a part of that future. So I think it's something that each investor has to decide on his or her own, as far as would they be okay to invest in a company that's trading at about 800 times its earnings. Hey guys, so let's look at the DCF analysis, or try to perform a DCF analysis on using the one positive free cash flow number from 2019 that Tesla has for us. Again, this is $698 million for the current year's free cash flow. That is 2019, last year's, because 2020 hasn't ended yet. I'm using 14% as my annual growth rate. This is being very liberal. I'm being very generous with Tesla when I say that it's going to grow its free cash flow, which is the amount left over once all the expenses are paid. Using the discount rate of 10%, the long-term growth rate of 3%, that's I think accounting for once the 10-year period has ended into perpetuity. So it's more on the calculation on what Tesla's long-term prospects are. So not 10-year period, but more on farther beyond down the line. So 3%. The shares outstanding, 191 million. That's as of 2020. And the long-term debt is at 11,634, and that's in millions of dollars. So the way that the DCF analysis works is it's summing up what the amount would be after the first 10 years. So that's going to be the intrinsic value after 10 years of discounting the free cash flows into 10 years in the future and bring it back to the present value. You add that up with the cash flow that will be generated if you assume that Tesla is going to grow into perpetuity, and discount all that back to the present value. You add these two numbers up and you get the intrinsic value, which is 32,941, again in millions of dollars. And then you subtract the long-term debt from that number, and then you divide by the shares outstanding of 191 million. And that's the intrinsic value that you come up with, is about $112. And this is a traditional way. It's not I shouldn't say this is the way that you should go about evaluating a company like Tesla, given that it does not have a lot of history as far as free cash flows go. It's not a DCF analysis for Tesla is not the most reliable way to predict what the intrinsic value is. Now, if we were to find the intrinsic value for a Ford or a GM, it would be a different story, because it has a history. It has, shown that for the past 10 years, it has generated positive free cash flow. So it's easier for us to estimate what the annual growth for the free cash flow would be, and how the future's earnings, it's more predictable for us. But with Tesla, it's a different story, a whole different ballgame. But we're trying to fit in a model that works into Tesla. So might not be the best estimate, but it still gives us an idea that if we were to use it, it's about $112 per share. As now let's look at the expected rate of return, IV calculation. Over here, I copied and pasted the 10-year history of the free cash flows. As you can see, they've all been negative except 2019. And that is what the graph pans out for it to look at. As you can see, right around 2013, it's like, it's barely going to push it forward to a positive number. But in 2019, it is positive. So that's what the graph looks like. The expected future numbers, I'm assuming that Tesla is going to grow at 15% with a 25% probability. It'll grow at 2%, most likely probability 50%. And it's not going to grow. It's 0% growth of free cash flow. So where it's at right now, it'll have a steady growth. That's a 25% probability. Again, as you can see, this is not a negative scenario for Tesla. I'm not assuming that, hey, the numbers are going to go down, even though the tax credits and all have ended. I'm still giving the Tesla the benefit of the doubt that they can pull it through, and not using any negative numbers here. So that is what I'm assuming it's most likely going to look like into the future, I'm using 191 as the outstanding shares. The current stock price is about $1,600, and if we were to invest in Tesla right now at $1,600, we would have an expected rate of return of negative 5.2%. So if you invest in Tesla, you're most likely going to get a negative return on it, even if you were to hold it for 10 years, and what the growth of future cash flow would do. Now let's say if it were $700, right, you're still at a negative number. Now if you were at $150, right, you're at a 3.5, and the number that we got through our intrinsic value, it was about $112, and at that point you're getting about a 5.5% expected rate of return on that investment, which it pans out with the DCF calculation that we did, that hey, this is what the intrinsic value is. So most likely, as a value investor, you would buy that stock well below its intrinsic value, in which case it might be at $90 that you might purchase it. And in that case, if you were to purchase at that level, you would be getting a return of 7.5%. But at the current stock price of about $1,600, it is clearly not a good investment as far as the expected rate of returns go. Okay guys, so to sum it all up, we looked at the risk factors, we looked at what the business is all about, the two segments of the business, the contingent liabilities of Tesla. We tried to do a DCF analysis, we looked at the expected rate of return, and also looked at the financials of what Tesla was 10 years ago and what it's at right now. And after taking all of that into account, we know that Tesla has a bright future. That's undoubtedly true. The EV business is growing, but the more emphasis should be put on the energy storage and renewable energy side of things, since that is where the 21st century is going, and Tesla is very researched and ahead of the curve as far as battery storage, energy storage goes. The other thing that we looked at are all the risk factors. So we understand that Tesla is indebted. It has a lot of obligations to meet. The stock price is going to be volatile. Elon Musk is a key player, and if something were to happen to him, Tesla's future might be in jeopardy. We looked at the financial statements, where we saw that throughout the years the free cash flows had been negative, except in 2019 and for the trailing 12 months, which is when Tesla pulled a profit. And it looks like the fact that for the trailing 12 months, for the past 4 quarters, since they had a positive number, Tesla is most likely going to be added, or if it hasn't been already, to the S&P 500, which is one of the requirements to be added to the S&P 500. So it is a company whose PE is about 250 compared to S&P 500, which is at a 25. And after taking the financials into account, we did a DCF analysis where we saw that if we were to liberally give Tesla the benefit of the doubt with a growth of 14%, a 10% discount rate, we get a valuation of about $112 as the intrinsic value, as compared to the current stock price of $16.50. So it's very, very overpriced. If Ben Graham or Warren Buffett were to say that, hey, looking at a stock price, if it's way out there or if it's way below, I can look at Tesla's stock price and say that it's way too high and I'm not going to buy as a value investor, right? And now you might be a growth investor and see that, hey, you can predict the future and think that, hey, this company is going to take over everything, in which case, kudos to you. You predicted it right, but as a value investor, it's not something that would like to venture into. And then for the expected rate of return, we saw that if we were to purchase it at this level, it would be a negative return, so it's better off not to invest at this level. So hopefully, guys, you enjoyed this video. Again, it was pretty long. It took me a while to make. And I'm not saying that Tesla's stock price is going to go lower. It could very well go to 2,500, 3,000, who knows. All I'm saying is that the current level, the valuation is high, and it doesn't provide me the required return and the required margin of safety that I expect when I invest in any stock. So thank you guys. Hopefully you liked this video. Please do like, share, and subscribe. Thank you.